As of January 2023, I've been in the property industry for over a decade, which explains why I've lost most of my hair. Now, over the last 10 years, I've learned a thing or two about the importance of finance. And I say that with full conviction. Finance is 50% of the game. No money, no honey. So we're starting a new series on this channel to help you learn as much as possible about the intimate relationship between finance and real estate investing. And we're going to name this series No Money, No Honey. In this series, I will share my ongoing learning about finance and how it can affect your property investing game. So make sure to subscribe and keep an eye on this channel because I'm going to be sharing real client stories, how we created solutions with brokers to help them continue growing their property portfolios. Just a quick disclaimer before I get into this video. The information that we're going to discuss in today's video are not financial advice. They don't take into consideration your personal financial decision and you should always do your own due diligence and homework. Let's get into it. Kicking off with the basics, let's get some finance jargon out of the way. You will hear these terms on this series a lot, so it's good to know what they mean. Equity is a surplus value of your home after deducting the outstanding mortgage balance. For instance, if your home is worth $1 million and you owe $720,000, your equity is $280,000. You can use this equity for investing in property. So obviously you need to make sure that your property has equity, and which will allow you to do an equity release. An equity release is a financial product that allows property owners to unlock the value of their property without having to sell it, pay capital gains tax, selling fees, and so on. An equity release is an additional loan top-up on top of your existing loan. The amount of equity release is determined by your loan to value ratio. The loan to value ratio is a percentage of the property's value that you're borrowing, represented in a percentage. The bigger your deposit, the lower the ratio, which decreases your profile risk to the lender. Typically, homeowners aim to put down a 20% deposit. However, markets in Australia usually rise at a quicker pace than most of us are able to save, so it can get a bit frustrating. One way to get into the market sooner is by utilizing lender's mortgage insurance. Lender's mortgage insurance is a one-off premium that is typically capitalized on the loan and paid by the borrower when the loan to value ratio exceeds 80%. If you have a deposit less than 20%, you should factor in LMI as part of your total purchase cost. Lender's mortgage insurance is typically 2% of the purchase price. So if you're buying a property for $500,000 and putting down a 10% deposit, you would factor in a 12% deposit, which is $60,000. Our personal definition of LMI at work is love mortgage insurance, not lender's mortgage insurance. Mortgage insurance allows you to acquire and control more assets for less of your own money. If you understand how this works, you can buy a property sooner and leverage the equity in the property to grow your portfolio. For example, in 2020, I purchased an investment property and utilized LMI to buy it for little to almost no money down. I then built the property, and upon completion, I had decent equity in the property, so I did an equity release of about $130,000 and purchased another property within 1 week. I managed to buy 2 properties using only $40,000 of my own money, and I was able to do that because I used lender's mortgage insurance to my advantage. Today, both properties are sitting around 80% loan to value ratio, and the combined rental income from them is around $1,200 a week. If you want to find out more about how I bought 2 properties for almost no money down, check it out here, and I will add the link to the video in the description. Thank you so much for watching. I'm super excited to share with you more finance tips and how that can help you grow your property portfolio. I'll speak with you again soon.